That's great. Thank you so much for that very kind intro. Welcome, everybody. I agree with Patty very strong. This is a very cool place, Hudson Yards. So I've been here since 2021. Actually, my family was involved in the construction of Hudson Yards. So my dad, brother, cousins were all involved in putting the steel up to this place. So when this place was under construction, I was actually here walking around when it was still sort of like a skeleton. So I like to say I was one of the first Wells Fargo people to be here. But there's a lot to talk about. So I'd like to kind of jump right in. It's been a really sort of volatile year in terms of the economy. Right. And I think overall, my message to you all is one that is very positive, meaning we've seen very significant amounts of change, right, in a relatively short amount of time. Right. So whether it be, international trade, immigration, new tax policy, deregulation, we've had a whole slate of new changes that the economy has needed to digest. And the good news here is that so far this year, what we're kind of seeing is that economic activity has been very resilient, right? So maybe you can kind of go back to the start of the year and there's some choppiness with, you have, new tariffs as an example, and businesses reacted to that. You saw a big surge in imports. That kind of weighed on things. And then kind of reversed itself in the second quarter, right? But kind of through all the volatility, right? If you look at the core indicators of what's happening in the economy, right? The consumer, right? In the household sector, it's about 70% of overall GDP. That's been very, very solid, I would say. Maybe there's been a moderation, right? Because you have some things happening in the labor market. There's been signs that there's been a gradual cooling, I would say, and that sort of weighed on incomes and maybe made a more challenging environment for the consumer. But overall, consumer spending is still expanding, and that's a big part of the overall story. And then you have, what's been happening on the business side, right? So business investment has been, again, maybe if you kind of look at it very closely, it's been slowing, but we have very strong new growth in AI-related investment, right? So we'll talk more about that in a few minutes. But overall, what you have here is, some volatility associated with these policy changes. And it's been a headwind. But overall, the core pieces of the economy are still running at a pretty solid rate. So consumer business still kind of expanding. Now, the more interesting question to me is, okay, well, what's ahead? So we've had this resilient type of year. And, I think that mostly continues in 2026 and 2027. So if you kind of look at things on like a quarter-to-quarter basis, Q3, we actually, government's been shut down. That's delayed some of the economic indicators. We still don't have all the numbers in for Q3 yet, but it's kind of tracking to be actually pretty strong. Is that going to last, at that current rate, right? We're tracking things at above 3% right now. Likely not. But overall, I think for the next year ahead, I think it's still a story of resilience and potentially even stronger growth ahead, right? So you have a few key notable developments that I'd say are going to sort of lift economic activity. Right? So what's been happening over the past few months, right? The Federal Reserve has been reducing interest rates, right? So making monetary policy less restrictive, I think, ultimately results in stronger rates of growth. It's never like a short-term thing, right? With monetary policy, it sort of famously works in long and variable lags, right? So you don't know exactly when that 25 basis point cut is going to feed through to the economy. But over time, it will. So 2026, I think, is setting up just to be stronger based on the fact that monetary policy is starting to ease in. Then you have the potential positive impacts, I would say, from fiscal policy, right? So we had the one big beautiful bill that was passed this past summer. And as you kind of move through the course of 2026, I think that's going to help to be a benefit to the consumer and to businesses, right? So think, okay, February, March starts to come around. People start filing their tax returns. You start to realize that there's a larger child tax credit. Maybe, there's no longer reduced taxes on, tips and overtime, auto loans. There's all these different provisions that I think net reduce tax burdens on the household sector, especially at the median income and below, because there's income caps. And I think that helps. That's a benefit to growth, right? Especially on the consumer side. And then there's all these other provisions, bonus depreciation and a pretty lengthy list of things that are aimed, right, targeted at boosting business investment. So you kind of think you combine the impacts of easier monetary policy and expansive fiscal policy. I think you're kind of looking at a growth environment that's a little bit more positive in 2026. So overall, that's sort of our outlook, right? You can kind of look at it, things on a quarterly basis. If you're looking at this chart of GDP growth, you might see like a little negative in Q4. That's mostly reflecting the government shutdown, right? So not only we have the latest and greatest in terms of economic data, but government's shut down. It's not really buying anything. It's not, so that actually goes into GDP. The point here is, even though it's kind of soft in Q4, it reverses entirely in Q1 because the government's reopened. So overall, it's a very positive, I think, outlook. There's certainly some headwinds out there still, right? We're still looking at very high levels of uncertainty, which causes it's a challenging environment, right, for businesses who are looking to make significant investments, whether it be capex or headcounts, as an example. So there's still some headwinds out there, but again, it's still that resilient narrative. So let's dive in a little bit deeper here, right, and sort of go through some of the rationale behind the outlook. So again, the household sector is very important, and the good news here is that incomes are still flowing into the household sector, right? So the bottom left, I think, is probably one of the more important charts in the entire presentation. It basically just shows the rate of the annual rate of growth in terms of income versus spending. So those two lines should ideally kind of run close to one another. What you see is income growth has slowed down a little bit. So you see that blue line kind of moderating. That kind of suggests that red line, which is consumer spending, is going to maybe not accelerate, maybe soften up a bit. But overall, I think the key takeaway there is that consumer spending is still growing, as are incomes. Maybe there's a moderation on the horizon. But again, that's essentially 70% of the entire economy right there. So, what we're seeing, on a monthly basis, pretty strong rates of spending. Maybe there was a rough patch at the start of the year, but over the summer, from the best we can tell, consumers are still, in the aggregate, still out there spending. I talk a lot about, what economists usually do is we think of GDP, top line spending, top line investment. You have to note that if you kind of drill down, go, further into the details, what you see, it's not really an even story. Meaning, if you look at, say, lower income households, there's more strain there than like the top 10% of households in terms of incomes, right? So it's sort of a different story depending on if you're looking at median incomes and above or median incomes and below, with the median incomes and below sort of not experiencing the same type of growth. So I did want to note that. But in the aggregate, what you're saying is still pretty solid levels of spending out of the household sector. And then the big thing, and this is what everybody's focused on right now. It's what financial markets are focused on right now. I will tell you, just about every conversation I've had with our clients has been around the impact of AI. And for me, I'm an economist, so it's usually how's this impacting the economy. And what I say is it's in the data, right? It's no longer just the thing that's kind of floating out there in the ether that the young kids are doing, right? It's here. It's in the data. It's at Wells Fargo, right? Most firms are investing very heavily into the AI and just at a higher level, just like the tech build out, right? But you see that on the bottom left-hand chart, right? That's just the number of that's construction of data centers, right? Which is about 4 times higher now than where it was as recently as 2021, right? So you see this very robust growth segment. It's not just the data centers. It's software, it's hardware, it's just about everything, right? And this is where new investment is happening right now. Now the flip side of that is if you look at sort of the traditional like capex spending, equipment, factories, things like that, not quite as strong in terms of growth, right? In fact, I would say it's probably lagging a little bit, which makes sense because you still have interest rates that I would say are restrictive, meaning rates are high. That's going to be a limitation for traditional capex investment. But overall, you add this business investment on top of the consumer, and that sort of explains why we have this economy. I think that's right now still very resilient. So it's the consumer story, it's the AI story. I mentioned there's some headwinds related to uncertainty. I think that's still true, although it's getting better, right? So I'd say the peak of uncertainty was probably around April, right, when we had Liberation Day, and it was sort of a surprise, to many of us about the extent new tariffs were going to kind of be, levied. But I think and what we're showing here is the Economic Policy Uncertainty Index. But it was a very challenging environment, as I mentioned before, for businesses and households too, right? If you don't know what the economic ramifications are to do tariffs and just new policy in general, it's very hard to make a significant decision. Buying a house, for example. But for businesses, it's especially challenging, right? Especially if you're involved in international trade. And I can tell you, most businesses are, whether it's small or large exposure. Just about every business has some connection there, right? And so you can kind of imagine not just what are the economic implications of tariffs themselves, but what are the knock-on effects? And so it's certainly encouraging to see uncertainty come down over the past few months, but I'd still say we're running at high levels here, which if you think in terms of a macroeconomic context, that's just not that I would put that in the headwind bucket, not a tailwind. And then tariffs are still here, and there's some uncertainty with half of these are going through the Supreme Court. We don't have that ruling. Hard to say either way, but I think the overall takeaway is that tariffs are here. They're going to be a part of the story moving forward. For one, because it's pretty clear the Trump administration is kind of focused on this as sort of using tariffs as a way to, rebalance international trade in the United States' favor. But they're also generating significant sources of federal revenues, right? So I think this is sort of another aspect of everything where if you're trying to kind of think about the year or two ahead and where the effective tariff rate is going to be and what their impact is, I don't know whether the effective tariff rate, which has come up from about 2% to, by our estimates, about 20%. I don't know where that's going to end up, right? But what I can say, it's probably going to be higher than where it was, at the end of 2024. And one of the reasons I think that is because of these new revenues that the federal government are sort of taking in, which are pretty substantial, right? So you can use these revenues. So, maybe there's a dividend for lower income households that are coming. Maybe it's just going to be used to kind of pay down the deficit, which is very high. I don't know that, but I think you have to assume, as sort of a base case moving forward, that the tariffs are kind of here, and that businesses and households are going to have to make some adjustments to account for that. One of the adjustments that's kind of currently happening is that inflation is being pushed up by tariffs, right? And so, what you've seen over the past 6 months or so is that goods prices have come up. So if you think about overall inflation, it's goods and services. If you look at the goods side, especially goods which are imported, and you can see that red line, you've seen some upward movement, right? So specifically, this is household furnishing items. This is music instruments. It's a bunch of stuff that's imported. So tariffs are very likely causing this upward push. Now, there's other things happening on the inflation front that are sort of offsetting that, right? On the services side, you have a housing market that's still pretty slow, not a lot of inflationary input there. And then just broadly, right, commodity prices are, basically neutral to their impact on inflation. And overall, what you see is inflation, total inflation that's kind of come up, but it's not running away like we saw, say, in 2021 and 2022. So overall, top line inflation, I would think of it as running around 3%, right? It's a little bit different no matter, what index you're looking at specifically, but inflation has kind of come up. It got down to 2.5, now it's basically at 3. And it matters here because, the Federal Reserve is, in the process of easing policy. But this is sort of one of the interesting developments is how does the Federal Reserve handle inflation that's kind of moving away from their 2% target? And it's really an interesting question and one that financial markets are sort of actively trying to digest. But here's what I think is most likely to happen, right? So you have tariffs that are pushing up inflation, not severely, I would say, but still, when you look at top line inflation, it's got a 3 on it, basically, which in previous episodes, the Fed has been hiking interest rates. It's a little bit different now, right? Because tariffs theoretically are just a one-time hit to inflation, right? You put a tariff on something, the price goes up once. So long as there's not an escalation in tariffs, then the price goes up 0%, and that change in prices is inflation. So theoretically, over time, this should fall out of the overall inflation numbers. And I think that's certainly true, right? And you see that this is our inflation forecast. You see inflation coming up a little bit modestly, I would say, and then kind of falling back down. And the Federal Reserve has a dual mandate, meaning they have to look at inflation and the labor market. Specifically, they need stable prices and maximum employment. So it's sort of a challenge for the Fed right now because you have prices which are drifting higher, as we talked about, and then a labor market that's looking like it's softening and sort of moving in an unwelcome direction. Meaning, if you look at like employment growth, so we got some new data this week, which showed sort of a stronger result for September, but the trend in job growth has clearly slowed down, right? You're still kind of holding on, but you're kind of on the cusp, right? A positive and negative. That's not a great place to be in right now, where you have a labor market that's lost momentum. Hiring is significantly lower than at any time over the past 5 years. In fact, you can go back 10 years and you wouldn't see hiring as low as it is right now. So if we have this labor market where labor demand has softened significantly, you're not seeing companies fire in a significant way either, right? And so we call this as the low hire, low fire labor market, meaning it's, if you lose your job, it's very challenging to get a new one, right? But companies still really aren't seeing employee or sort of, firing employees in a really material way. So you see that in jobless claims, which have kind of come up a little bit. And yes, I certainly acknowledge that there's been some recent headlines about large-scale layoffs, but that's sort of typical for an economy that, that there's a lot of hiring and a lot of firing that goes on every single day, week, month, year, et cetera. So overall, you have a labor market that's lost momentum. It's still kind of, it's still kind of holding on, but it's still one that's, I think, in danger of kind of moving in a negative way. Now, the unemployment rate has come up, but not a lot, right? And I think that's the best reflection of that, right? You still have a 4 on the unemployment rate, which is generally okay. We're still a little bit below 4.5, right? And I think this is something that the Federal Reserve is going to be kind of paying close attention to, especially when they meet at the December meeting, that you have all these supply dynamics happening in the labor market too, right? Which kind of makes things even more uncertain, right? So the unemployment rate, the denominator on the unemployment rate is the labor force, which is closely tied to population. We've had some big changes in population, we think, this year, mostly tied to immigration and just a more restrictive stance there. So we don't have all the data there yet, but from what we can kind of estimate is that slower labor force growth vis-a-vis some of these immigration policies is probably putting downward pressure on the unemployment rate. So it's kind of concealing some of the weakness that might be emerging in the labor market. So it's overall, the unemployment rate's still low. It's come up. It's not spiking, right, which is good news. But overall, it's kind of making it a challenging thing for the Federal Reserve, right? So you kind of put this all together, right? And long story short here, we are anticipating the Federal Reserve to cut rates a few more times over the next 6 or so months, right? So we had a 25 basis point cut in September, another one in October. December has become a little bit more uncertain, right? For all the reasons we talked about, right? Because you have some people in the FOMC that they're looking at the inflation numbers being around 3%. Some people at the FOMC are looking at the labor market and seeing very moderate job growth and a slowly rising unemployment rate. So depending on where your kind of focus of attention is, that is sort of going into your quote unquote your response function on where you think monetary policy should go. At the end of the day, though, what I think is very likely to happen in December is that maybe you get some more data. You get the data that's been postponed because of the government shutdown. That's probably going to show that economic activity, probably still holding on, but maybe at a slower rate. The labor market, we're not going to get an October jobs report. Unfortunately, we're not going to get an October inflation report from the CPI, which will be interesting. So there's still going to be, I think, a toss-up, but I think they're going to lean towards kind of cutting by 25 basis points, just on, the basis of the downside risks in the labor market are probably larger than the upside risks in inflation. That's kind of how the Fed thinks of things, and I would agree with that, actually. So how you read this is another 25 basis point cut in December, and then two additional 25 cuts in the first half of 2026. Kind of gets you to a terminal rate of between 3 and 3.25. So more cuts, I think, are coming. Monetary policy is still, I would say, restrictive, meaning it's impacting pockets of the economy. That's clear, right? You see it in the real estate sector, you see it in the manufacturing sector, transportation. There's all these sectors where, yes, the consumer. The AI is sort of allowing growth to continue to expand, but there's other parts of the economy which are not growing quite as quickly. And a large part of that I would chalk up to the effects of higher interest rates. So let me stop there. I'm sure there's a question or two, and I think we have time to handle those right now. Yes, sir. Yes. Whoever wants to go first. Yes.
I wanted to get your thoughts on the Clarity Act.
Which act is that?
Clarity Act, where companies will be able invest in cryptocurrency and regulated and how that's going to affect businesses?
Yeah, it's hard to say one way or the other. It's kind of been interesting past couple of weeks on the crypto side. It looks like there's some downward price movement, and it's hard to say any one way or the other. I can't speak to the impact specifically to Wells Fargo, but from the economy side, I think it's been a really interesting and unclear impact. So one of the themes I've been talking about is the consumer's been resilient. The consumer's been resilient, and I think that actually aligns well with some of the wealth that's been built up from the very significant rise in cryptocurrency, and you can look at Bitcoin prices as an example for that. So I think there's pockets of the economy that we're not doing a great job of kind of tracking, right? Is the moral of the story there. So I think there's some wealth out there that I think is helping support the consumer. So that to me is becoming more evident over time, and I'm certainly looking forward to getting more data there. But to the specific question, I just don't have any big commentary there. Go right here.
I just want to get your take on the circular nature of things with AI, et cetera. What kind of impact could that have? What's your take on the precedents?
To me, it's more reflective of a supply constrained and burgeoning sector, right? Whether it be chips, and I'm not the AI expert by any means, but that's something you tend to see when it's not like there's this big source of chips available where everybody can go and get them, right? And so when you have just a few companies that are able to produce such a thing, it makes sense to kind of see that sort of trend, right? So it's if you're thinking about downside risks here, it's probably on the list, absolutely. But I have trouble, seeing or sort of estimating the full kind of risk there. But to me, the overall story makes sense in that it's just very constrained still, because one, demand is just, by all accounts, just very, very strong, and there's just not enough supply that's sort of plentiful to kind of meet that demand. Yes. Mm-hmm. Yeah, that sort of rotation has been there for a while, and I think it speaks to some of the strains you see sort of median income and below, right? So basically everything we track over the past 3 years said, inflation is hitting the lower income segment harder, right? And you're seeing wages that were growing faster for that segment, before the pandemic. Now they're kind of slowing at a faster rate. So you're kind of seeing that median income kind of segment moderate quicker, right? And so I think that's why you're seeing strains, generally speaking, within that cohort. But I think the message here is that I think you assume, okay, the economy should continue to expand. The longer you get into a cycle, the higher the likelihood the benefits start to kind of flow back towards those individuals, right? So as an example, before the pandemic, we basically had a 10-year loan cycle, which was one of the longest in our nation's history, right? And towards the end of that cycle, that's where you saw, as I mentioned, wages really coming up faster for the lower income households. So I think, it's hard to say exactly, when that kind of shifts. But the Federal Reserve, and they've said this, multiple times, they're very focused. Not just the Federal Reserve, by the way, the Trump administration too. They're very focused on sort of supporting that segment. So maybe that you do see stronger growth. The economic cycle continues. Maybe you get firmer wage and income growth at that segment, and maybe that allows for more discretionary type spend. But it's hard to say, exactly when that would happen.
One more.
One more. Okay. Yeah.
Yeah. So AI investing, AI. Are we seeing productivity that are we looking at a lot?
Not yet. I mean, it's hard. It's that. So that I'm not going to go too into the weeds here, but that has always been very hard to measure. And there's not a great way of doing it. Sort of thinking, is it having an impact now? So with we don't have great data on it. I would say it's starting to in different pockets. Is it showing up on like a macro level? Probably not. But yeah, if you look at certain industries, right, like software programming, AI has pretty clearly made that more productive, right? I think generally speaking, we're still in like the initial phases of adoption, right? Where more people are using it, businesses are spending a lot of money to sort of integrate it, but we're not yet seeing the ROI currently, right now. And it's clearly, I think, very something that could enhance productivity at a minimum and like significantly boost productivity in the years ahead. It's just not really showing up in the data yet. So we'll see. All right. Thank you very much.